Hey, hey everybody, I'm Keegan,
I'm James.
and this is our presentation on market cap and indexes. So, what is market cap? Market cap is short for market capitalization. This term refers to the total value of all company shares of stock.
How to compute the market cap? It's computed by multiplying the price of the stock by the total number of shares in the company. For example, let's say a company has 10 million shares selling at a price of $20 per share. They would have a market cap of 200 million. And as you can see, this is a formula, same thing we used before, but just in a different format.
So, why is market cap an important concept? So, market cap allows an investor to understand the relative size of one company versus another, which can be used in investing. So, market cap measures what a company is worth on the open market, as well as the market's perception of its future, because it reflects what investors are willing to pay for its stock.
So we have three different types of market cap companies. We separate them by their market value, starting with large cap companies. They're typically firms with a market value of $10 billion or more. They have a reputation of producing quality goods and services, historically consistent dividend payments, steady growth. These are companies that you've heard of for the vast majority. Companies have been out there for a while, reputable names. As we said there, their brand names may be familiar to a national consumer audience. A few examples: you got Apple, Coca-Cola, Nike. The list goes on.
So, investing in large cap firms. Investing in large cap stocks may be considered more conservative than investments in small cap or mid cap stocks. You'll see why. But these investments usually pose as a less risky investment in exchange for less aggressive growth potential. And that's exactly why it's a more conservative approach in investing. Yeah.
Now we have mid-cap companies. These companies typically between market value of 2 billion and 10 billion. They're typically established companies in industries experiencing or expected to experience rapid growth. They may be in the process of increasing market share and improving overall competitiveness. This stage of growth is likely to determine whether a company eventually lives up to its full potential. So these type of companies probably haven't heard of them, but they're obviously still successful if they have a market value between 2 billion and 10 billion. But they're not as reputable as the large cap like Apple and Coke and such.
So investing in mid cap stocks generally fall between large caps and small caps on the risk return spectrum. So mid caps may offer more growth potential than large caps and possibly less risk than small caps. So in terms of riskiness, it's right in between large cap and small cap, as we said. And the return is going to be greater than large cap, but not as great as small cap.
Finally, we have small cap companies. These are companies with a market value between 300 million and 2 billion. These are young companies serving in niche markets or emerging industries, and small caps are considered the most aggressive and risky. You have a very high chance you haven't heard of any of these type of small cap companies. If you have, you'd be in the minority there because these companies are very young, starting to grow. Most of them you probably never hear of, because they typically fail a lot since they're so risky. But the ones that do succeed will be, like exponential growth.
Yeah, and as James was saying, like small cap companies, you probably never hear of unless you do your own research. These are like the penny stocks that you may have looked at, very small market cap, and yeah, they pose a very risky investment. So going off of that, investing in small cap companies. So the relatively limited resources of small companies can potentially make them more susceptible to competing businesses in economic downturn. So they may also be vulnerable to the intense competition and uncertainties of markets. Small caps may offer significant growth potential to long-term investors who can tolerate volatile stock price swings in the short term. So once again, I mean, these are kind of boom or bust. You're either going to lose money or gain a lot of money.
What could impact a company's market cap? There are many factors here at play. Just a few that we want to mention that we thought were most important were changes in the value of shares. This could be, an increase in the value or decrease. Changes in the number of shares issued, and also an exercise of warrants on a company's stock. So basically, a warrant is when investor will buy the right to buy the company's stock at a discounted price, so priced less than the market price at the time. And they can only do that and exist at a certain point in time, which would be stated in the warrant. But when those are exercised, the company's market cap will change as well. Also, economic conditions will affect it as well. You know, if the economy is in a growth period or a recession or depression.
So the implementation of market caps into diversified portfolios. So a diversified portfolio, which many of you have probably heard of, contains a variety of market caps, and that may help reduce investment risk in any one area and support the pursuit of your long-term financial goals. So this is the concept of not having all your eggs in the same basket, right? So you don't want all your eggs to be just small cap, right? You want a wide, like a spectrum of market caps in your investment portfolio. So now we're going to get into indexing. So
what is an index? So an index tracks the performance of a group of pre-selected investments, such as stocks. So, for example, one of the most notable ones in America, S&P 500. It's an index that tracks the performance of the 500 largest U.S. companies. You know, these 500 largest companies, most of them will stay, but it's rebalanced every quarter. So 4 times a year, the S&P will rebalance the 500 that are actually in that group, and then investors can gauge the performance of stocks, bonds, mutual funds by comparing them with the performance of an index. So a main theme for indexes is comparison. That's a big reason why investors would either A, look at them, or B, invest in them. It's a good way to compare it based on the market. And you know, this is the S&P 500. It's the little image that we found.
So index investing. So individual stocks and actively managed mutual funds attempt to beat the market, which means that the given stock outperforms their benchmark indexes. So these attempts can fail, and quite notably, they usually do fail. So investors use passive investing strategies such as index funds that aim to mirror broad market or sector performance rather than beat it. So they're just looking to mimic, right? Mimic an index rather than, you know, individual stocks and actively managed mutual funds that try to beat this index.
In investing, indexing is a passive investment strategy. This is a big idea that we want you guys to get. You're creating a profile or portfolio that tracks common market index, such as the S&P 500. It's mimicking the index's performance. So with the individual and actively managed mutual funds, you're not going to mimic, you're trying to beat it, as Keegan said before. That's an active strategy. With indexing, it's a broader diversification, lower expenses, and you basically just putting your money in there and riding with it. You're not doing anything special with the individual and active mutual funds. You know, they're higher expenses because you're doing more research and you're actively watching them. You know, and those expenses can be monetary, time, you know, a number of those.
So is index investing a smart way to invest? Indexing is a good investment strategy for many people. And like we stated before, it creates a diversified portfolio and it usually requires lower fees and expenses. So that's a key concept to understand, is that it's lower fees, right? Because you're not paying a mutual fund to manage your portfolio. You're just letting the index do its work, right? So it also mimics the broader stock market, which over the long run will generally perform better than any single person picking stocks. And this has to do with mutual funds as well. Usually indexes outperform mutual funds and individual investors.
And then just another additional point with bond indexes. So not all indexes are stock-based. You got, you know, the S&P and Russell, they do equities like stocks, but there's also bond equities like Bloomberg Aggregate and Merrill Lynch Domestic Master. They're tracking bonds and they're measuring corporate bond portfolio performance.